Hello and welcome to the lecture for the first part of Chapter 16. So this chapter deals with auditing operations, so a focus on revenues and expenses, and then the steps necessary to complete the audit, so to kind of wrap things up at the end. So I'm going to first talk in this lecture primarily about revenues and expenses, the relationship between those kind of accounts and balance sheet accounts, and then some substantive procedures to take with regard to those accounts. In the second part of the lecture for this chapter, I'll talk about payroll-related issues, and I'll talk about the steps necessary to complete the audit. So first of all, in terms of looking at operations and income statement accounts, it can be tempting to think that, well, we've looked at all of the balance sheet accounts, and through looking at the balance sheet accounts and auditing them, by necessity, we've also looked at a lot of revenue and expense accounts. As an example, when we look at accounts receivable, we're also looking at revenue accounts. So it can be tempting to think, well, we've already covered this. The reason that that there's a requirement to kind of look at this separately is there are errors and frauds that can occur that a focus on balance sheet only wouldn't capture. So as an example, a guy that I used to work for was auditing a company, and the bookkeeper that ran payroll was engaged in kind of an interesting fraud where she increased her gross pay and then increased her federal income tax withholding by an identical amount. So you can go off the charts, or you can just state a specific amount you want withheld from your paycheck for federal income tax. And so she did that all year long, and then at the end of the year she'd file her income tax return and get a really large refund. Well, if your focus was solely on the balance sheet, you would say, are there wages payable at the end of the year? Yes or no. If there weren't, if it was paid through the end of the year, then that would be zero and you wouldn't catch anything there. And if you looked at payroll tax liabilities, so was there federal income tax withholding payable outstanding at the end of the year? Well, if that had been paid and that liability was zero, then there would be nothing to find there. So looking just at the balance sheet accounts wouldn't capture that particular type of fraud. And we'll talk in this lecture about ways to capture that kind of misstatement or fraud. It could either be an error or it could be fraudulent behavior. So that's kind of why it's important. The other reason it's important is that corporate earnings are a big deal. And the company's net income, their stock price is often tied very heavily to that. Expectations of future earnings are based on current earnings in many cases. Compensation of officers and executives in a company can often be tied to net income, and earnings per share, which of course is related to net income. So there's a lot of importance in that figure. The book talked at length about the role of conservatism, and I thought it was kind of one of those interesting tangents that the book goes on, where they talk about why conservatism is very important, but then they state that FASB prefers neutrality, which I tend to agree with. It shouldn't be optimistic or pessimistic, it should be neutral. So the objectives for auditing revenue and expenses, I guess similar pattern to what we've seen in past. With respect to revenues and expenses, we would look at inherent risks. So how critical is the subject of earnings to companies' management? If you're auditing a single owner business, it may not be particularly critical. If you're auditing a publicly traded company, it might be very important. If you're auditing a company that is close to violating covenants and that there are profitability covenants included in its loan documents, it could be very important. One of the things I've found in the past is that companies that are kind of preparing themselves to be sold or to be acquired can place a lot more emphasis on earnings, because many times a purchase price for a company is based on multiples of EBITDA, earnings before interest, tax, depreciation, and amortization. So it could take on more importance in those kinds of roles. So I would look at what the inherent risks of the client are relative to those kinds of things. I would look at their system of internal controls, and then taking those two assessments together, and I'll talk more about internal controls in a little bit, especially when I talk about payroll. I would take a look at those two things, and that would inform my assessment of the risk of material misstatement, which of course then would influence the type of substantive procedures that I would do. So to continue talking about objectives for the audit of this category, I would establish that the recorded revenue and expense transactions have actually occurred. So that would be going from the trial balance to source documents to see are the assertions that management is making about these financial or economic events, did they actually happen, or were they created falsely? I would look at the completeness of recorded revenue and expense transactions. Here, in the case of occurrence, I would be more concerned about did revenue actually occur as opposed to expenses. And with completeness, I would be more concerned about are all of the expenses recorded. It's unlikely that people will intentionally underreport revenue. So in looking for completeness, did all of the expense transactions that should have been recorded, did they actually get recorded? And in that case, I would go from source documents to the trial balance. I'd go in the other direction on the audit path. I'd make sure that all of the revenue and expense transactions were accurate so that there weren't mathematical errors or pricing errors or estimation errors with regard to either revenues or expenses. I would verify cutoff. Of course, we'll do that when we look at accounts receivable and accounts payable. That will influence quite a bit of that, but we would look at that separately here. And then I would take a look at the presentation and disclosure. So were the transactions recorded to the correct accounts? So as an example, just saying all the total of expenses is correct and that's enough. Well, what if a company miscodes some administrative expenses as research and development expenses? So their total expenses are the same. They didn't misstate their net income, but they've made it appear that their company is doing more to invest in the future than it might really be doing. So there could be distortions in the story that the financial statements tell with regard to miscategorization of expenses or misclassification, to use a word in the lecture notes here. And then making sure that the earnings per share information that's required to appear on the financial statements, that is correct and the math is correct and so forth. So here's a chart that just gives you an idea, and I won't go over every detail of this, but just an idea of the relationship between balance sheet items and revenues and expenses. So of course, when we talk about accounts receivable, when we audit that on the balance sheet, we're also going to pick up information about revenue, and with regard to expenses, we'll look at bad debt expense or uncollectible account expense. Those are all related items. Jump down to inventory. If we audit inventory, we're also going to be touching upon cost of goods sold and some payroll information. So you can see a lot of these, of course you know this from all the accounting classes you've been in, there are a myriad of relationships between balance sheet items and revenue and expense items. So miscellaneous revenue is a category that bears some special attention. If we were in class together, I would probably go on about a 15-minute diatribe about how I despise miscellaneous anything. I think in companies, it's a case of accountants being lazy. There's no reason to not have accounts for small items and have more accounts. It's always easier to consolidate accounts than it is to have an account that's called miscellaneous that gets out of control and has too much activity in it, and then you've got to break it out. So you pretty much only have to spend time doing that once to realize that it's better to classify things correctly and have all of the accounts in your chart of accounts that you need to describe what happened in the business. But enough with that. So miscellaneous revenue, it's possible that it could contain some items that should have gone somewhere else. Some things that often get recorded, and what happens is cash comes into a business, the bookkeeper doesn't know how to categorize it, and so they plug it to miscellaneous revenue because they're going to debit cash, they have to credit something, so they may as well credit miscellaneous revenue. Well, some of the places that may come from, one, a collection on a previously written off account. Well, the credit should be to build back up the allowance account. It shouldn't be to miscellaneous revenue. Sales of scrap often get recorded as miscellaneous revenue. It should get recorded as a credit to cost of goods sold. Rebates or refunds on insurance premiums, that of course should be an offset to insurance expense. And then proceeds from the sale of plant assets, that could have an influence on the value of the new asset if it was a trade-in situation, or if it was just a straight up sale, then it would have an influence on gains or losses for that transaction as opposed to miscellaneous revenue. One of the reasons to look into this is the fact that companies want to show revenue growth, and if each of these four items I've just described had been recorded properly, it would have diminished the growth that the company was showing. So it wouldn't have had an effect on the bottom line, of course, but it would have had an effect on the growth of revenue that they show. So if an auditor comes across these items, like the four examples I just gave you, what should they do about it? Well, the first thing they should do is propose an adjusting journal entry. And I found T accounts are really the best way to do that. So to T account, where is the account at? Where do I need it to be? So what entry needs to happen to get it from where it's at to where it needs to be? That's kind of the basic step there. We'll perform analytical procedures, investigate unusual fluctuations from period to period, and that's kind of what we'll do in this category. So now kind of the meat and potatoes of this area, substantive procedures for SG&A, which is selling, general, and administrative expenses. So overhead is another term for that. So here's a pattern that we've looked at before in other categories for an analytical procedure. So the first step is for the auditor to develop an expectation of what an account balance should be. What should insurance expense be? What should advertising expense be? Those sorts of questions. And then they should look to past audits, so past year's information. They can look to industry averages. They can look to, really budgets are an important source of this kind of information. So if the company does have a good budgeting system, that can be a source of what should the account have been. And then they can determine how different is the actual result from what I, the auditor, think it should have been. And whether or not I dig into that more deeply is going to depend on how big that difference is relative to our measure of materiality for that particular category. So if it exceeds the materiality, well, we're going to dig in more deeply. One thing I would say about a budget system is that it's important to note what steps the client takes to investigate deviations from budget. So in some companies, the budget is just a document that sits in a desk drawer and they drag it out at year end. Oh, how did we do? In other companies, there's a very structured process for recording deviations, disseminating that information to the people that control that those spending or revenue accounts, and then investigating deviations and all of that. So that would be important to look for. Okay, so I would obtain an analysis of selected expense accounts, and the AICPA suggests at a minimum looking at things like advertising. Many times advertising is paid for in advance, at least that's been my personal experience. And so there could be advertising that's been either expensed when it should have been in prepaid costs on the balance sheet, or the other way around. It was in prepaid costs on the balance sheet and should have been released to an expense account and wasn't. That's easy to do. If you prepay for advertising in June and the advertising doesn't start until later in the year, there's nothing really to trigger the accountant later in the year to say, oh, that ad ran, I should credit prepaid and debit advertising expense. So it's an easy thing to miss. Now, hopefully you'll catch that when you're auditing prepaid costs, but again, it's important to look at it from this angle as well. Research and development, that should be an account that looks that we looked at, make sure it hasn't been inappropriately capitalized in any way, that it's been accounted for correctly. Legal expenses and other professional fees, one of the things that we'll use that for is to capture the names of law firms to look at potential contingent liabilities. And we'll talk about that more in the next lecture. I'd look at maintenance and repair expenses to see if they've been recorded according to the company's policies for capitalization. And then we would look at rent and royalties. I would also look at critical expenses on an income tax return and see how they compare to the financial statements. So last, here is an example of a working paper for looking at professional fees expenses, so lawyers' fees and other professional fees. So you can see here they've documented what they were, the copy of them. There was an adjusting journal entry, and then an adjusted balance and all of their footnotes and who looked at it and who reviewed it and all of that. So good example of a working paper in this category. So that's the end of the lecture for part 1, and we'll pick up where we leave off here with payroll with the next lecture. Thanks for your attention, and as always, please don't hesitate to give me a call or shoot me an email if you have any questions at all. Thank you. Bye-bye.